At 9:02 in the morning, you walk into a bank and deposit $1,000. Nothing dramatic happens. No alarms. No flashing screens. Just numbers on a screen. But somewhere, quietly, that $1,000 is about to become $10,000. Not over years. Not through investment genius. Almost instantly. And no, the bank didn't steal it. They didn't find it. They created it. Out of nothing. We've been told money is scarce. You have to earn it. Save it. Fight for it. But the uncomfortable truth is this. Most money in the modern economy isn't printed by governments. It's created by banks. Every single day. And most people never notice. This matters more now than ever. Because when interest rates rise, when housing becomes unaffordable, when inflation quietly eats your savings, you're not just feeling the economy. You're feeling the consequences of how money is created. So let's pull the curtain back. Not with jargon. Not with textbooks. Just by following the money. Start with your $1,000 deposit. You think the bank takes it and locks it in a vault. That's the story we've all been told. It sounds safe. Responsible. It's also not what happens. The bank keeps a fraction of your deposit. Let's say 10%. The rest, it lends it out. So your $1,000 becomes a $900 loan to someone else. Maybe it's a small business. Maybe it's a car loan. Maybe it's a mortgage. That borrower spends the $900, and the money ends up back in the banking system. Another account. Another bank. Now that bank keeps 10% and lends out $810. Then $729. Then $656. Over and over again. Your original $1,000 just multiplied. No new physical cash was printed. No gold was mined. Just numbers expanding across balance sheets. By the end of this chain, that $1,000 can support nearly $10,000 in total money circulating in the economy. That's not a loophole. That's the system. Here's where it gets strange. When the bank gave out that first $900 loan, they didn't take it from someone else's account. They created a new deposit. Out of thin air, a borrower signs a loan agreement. And suddenly, money exists that didn't exist before. It shows up in their account like it's always been there. Spendable. Transferable. Real. Because in modern banking, money is not just cash. It's credit. And credit is created with a signature. That's the quiet magic trick. Now, if this sounds unstable, that's because it kind of is. Banks are creating money based on the assumption that not everyone will ask for their money back at the same time. Because if they did, there wouldn't be enough. That's called a bank run. And history has seen plenty. Moments where confidence breaks, and the system reveals what it really is. A delicate balance of trust. So why does this system even work? Why hasn't it collapsed already? Because of three things. Trust, regulation, and a backstop. First, trust. You trust your bank will give you your money when you ask for it. The bank trusts borrowers will repay loans. And the entire system runs on that shared belief. The moment trust disappears, everything starts to shake. Second, regulation. Central banks set rules, reserve requirements, capital ratios, limits on how much banks can lend relative to what they hold. Not to stop money creation, but to keep it from spiraling out of control. At least in theory. And then there's the backstop. When things go wrong, central banks step in. They inject liquidity. They print money. They rescue the system. In 2008, when the financial system nearly collapsed, trillions were created to stabilize banks. Not slowly, not cautiously, quickly, decisively, out of nothing. Because when the system breaks, there is no backup system. Here's the irony. When regular people hear money printing, it sounds reckless, irresponsible. But banks have been printing money all along, just in a quieter, more technical way. And instead of being called inflation, it's called lending. Now let's zoom in on something subtle. When banks create money through loans, they also create debt. Every dollar created this way is tied to an obligation. Someone has to pay it back. With interest. That means more money needs to exist in the future than exists today. So the system depends on constant growth. More borrowing, more lending, more money creation. If that slows down, things get tight. This is why recessions feel the way they do. Banks become cautious. They lend less, which means less new money enters the system. Businesses struggle. People lose jobs, not because money vanished, but because less of it is being created. And when central banks try to fix this, they often lower interest rates. Cheaper loans, more borrowing, more money creation again. It's like pressing the accelerator to keep the engine from stalling. But there's a trade-off. Too much money creation, and you get inflation. Prices rise. Savings lose value. Assets, like real estate and stocks, inflate. Those who own assets benefit. Those who rely on cash fall behind. This is where the system starts to feel uneven, because the newly created money doesn't reach everyone equally. It enters through banks, loans, and financial markets, which means it often flows first to those already closest to the system. Large companies, investors, asset owners. By the time it trickles down, prices have already moved. So while the system is technically creating money out of nothing, the impact is very real. It shapes who gets ahead and who struggles to keep up. Now step back. This entire system runs on something invisible. Not gold, not paper, but confidence. Confidence that loans will be repaid. Confidence that banks are stable. Confidence that the numbers on your screen actually mean something. Because at the end of the day, money is just a shared belief. And banks, they are the institutions that expand that belief. Carefully, strategically, sometimes aggressively. So the next time you hear that money is scarce, remember this. It can be created. It is created every single day, not by governments alone, but by banks with every loan they approve. And here's the question that doesn't get asked enough. If money can be created out of nothing, who decides who gets it first? And what does that mean for everyone else?